It is hard to do last minute planning when it comes to required minimum distributions. We've got a live case I'm going to walk you through on some last minute planning opportunities that we're going to do for this couple, but I urge you, take a proactive approach, get ahead of the planning for your required minimum distribution. I'm going to explain why, that and more coming up. When you're first getting started in your 401k, it's very easy to just say, I don't know, I'll contribute. How much do I need to contribute to get the full company match? Okay, I'll do that. And then I'll just contribute pre-tax, so I get a tax benefit today. I'll do some, typical investment. Okay, off to the races. Now back to, what I really am focused on. And then that sort of thinking, that lack of intentionality sort of builds and compounds and grows. And, what is it? The days are long, but the years are short. And I'm feeling that right now, by the way, with 3 kids. And we had an individual reach out and come in to see one of our advisors just recently, that you can very clearly see that's what happened. Where in this situation, this individual they've saved up significantly. However, he is now knocking on the doorstep of required minimum distributions, RMDs, needs to start next year, has not done any planning, and it's going to create an enormous tax surprise and tax pain. So before I get into that scenario and share some of the last minute planning that we're going to do, I just want to urge you, if you're not yet 73, if you are still in your career, maybe early in retirement, work with your certified financial planner, and your CFP can't just be doing investment management, because that's what this individual's gotten. They've just gotten a lot of execution, no strategy. No strategy that includes, okay, wait a second, when you start climbing down the mountain, what's the impact going to be? How will this fit with your cash flow, your taxes, your estate plan, your protection plan, your health insurance? How's this going to work? There needs to be that level of proactive intentionality so that you can plan ahead and marry both strategy, what makes sense, looking at all 6 areas of your financial life, and execution. Let's start implementing it as it makes sense to do so. Strategy and execution. You can do that even if you're in the late stages of your career, beginning to do that work with your CFP so that you're not doing last minute planning when it comes to your required minimum distributions. That can save you a lot of strife, a lot of concern, a lot of taxes. And that's what sort of welled up and why this individual decided to reach out to us. He's been a fan for a long time, and yet he's got to the point where he's like, okay, I'm pretty sure I'm going to have a problem. I'm pretty sure I'm going to have a problem. The situation is he's 72, starts his required minimum distributions next year. Spouse is a little bit younger than him, so she's not at required minimum distribution just yet, but he has in his pre-tax retirement account $2.5 million. What a fantastic problem to have. $2.5 million. They've never withdrawn anything. They never have. And he has known, at some point I'm going to have to withdraw these dollars, but he's never done the math. He's never looked at what sort of required minimum distribution would be required. And he's never done the proactive tax planning. The only thing he's gotten is strategy around the investment approach. Okay. And he's done very well, but it's time for an overarching strategy. And that concern was keeping him up at night and why he decided to reach out. Situation, again, I told you their ages. In addition, they've got a decent amount of cash, a pretty significant amount that they've been living off of in addition to their, call it $50,000 of Social Security. They don't really spend a lot of money. Therefore, they've never really needed to draw money out of their IRA. They just sort of supplement what they need with the, large amount that they have in cash. But here's the kicker. For the past several years, really since they retired, they've paid no taxable income. They've had no taxable income. $50,000 or so of Social Security, another 10 grand of interest income. As a married couple, that means essentially none of the Social Security has been taxable to them. Oh, I love that, right? That's got to feel good. No tax on their Social Security, but that means 10 grand of adjusted gross income. Your standard deduction, call it 30 grand. It's a little bit more than that. Call it 30 grand. That means they've had negative $20,000 of taxable income for the past several years. And yet, there's $2.5 million they're going to have to pay tax on as they withdraw, and they're going to need to start withdrawing those dollars coming up next year. big opportunity missed. Big opportunity missed. And that's not something to dwell on, not something to oh gosh, well, what a big mistake. No. We've all made financial mistakes, but it's a necessity now to, even though at this late hour, to start doing the planning. If you do the math to calculate what the required minimum distribution will likely be on $2.5 million, just call it approximately 4%. Okay, so that'd be about 100 grand. But there's actually a calculation that's done every single year based on the value of your pre-tax accounts as of 12/31 of the previous year and your life expectancy factor, which is from a universal life table that is that's sort of published. So you don't have any control over this. So 2.5 million, let's pretend 12/31 of 2026, the value of all their pre-tax accounts, 2.5 million. The life expectancy factor is 26.5 at age 73. So you take your $2.5 million and you divide that into 26.5 and you get about $94,000. So again, round up, let's just call it $100,000 that they are required to take out of their pre-tax accounts starting next year. If everything stays the same, they've got their $10,000 of interest income, they've got their $50,000 of Social Security, and now they've got this $94,000, call it $100,000 of IRA withdrawals that will land on their tax return in 2027. That $50,000 of Social Security, not all of it will be taxable, but they're going to go from none of it being taxable to the maximum amount, which is 85%. 85 cents of every dollar of Social Security is going to be taxable to them. So sort of recreating their tax return just sort of in thin air, you got the 10 grand of interest, you've got $42,500 of taxable Social Security, plus the $100,000 of required minimum distribution IRA withdrawal. So there you have it. Your adjusted gross income is now significantly higher, call it $152,000. Your standard deduction is around 30. Again, it's going to be a little bit higher than that, but call it around 30. You're going to pay tax on approximately 120 grand. Now, technically in 2027, the senior deduction will still be available. So they should each be able to get $6,000 in senior deduction. So another $12,000 should come off. So therefore, in 2027 and 2028, they'd be paying tax on 110,000, not 122, but I'm using round numbers anyway. Well, they're not only going to be in the 0% tax bracket. No, those days are long gone, right? They've filled up the 10% and filled up the 12%, and they're sitting in the 22% tax bracket, and they're going to be there for the rest of their life, right? Because this required minimum distribution, these IRAs, yes, they're drawing about 4% out, but hopefully that IRA is growing by more than 4%, right? So their required minimum distribution is getting bigger every single year, hopefully because the account is growing, but also because they're getting 1 year older, and therefore that divisor gets a little bit more harsh, right, in the calculation. And so they're going to be in this middle tax bracket forever. And if and when one of them passes away, now you've got that much income squeezed into single tax brackets, meaning they likely could be in the 24% tax bracket. So again, ideally, you've done proactive RMD tax planning and you don't have all of your eggs sitting in the pre-tax bucket. You've created some tax diversification for yourself. But that's what we need to do right now. So for them, we've taken a look and we're going to start doing multi-year tax projections. Again, we're just getting started working with them, but we're going to take a look and say, all right, well, you're now going to be in the 22% tax bracket starting next year. So this year, how much in Roth conversions can we do to get you into the 22% tax bracket, but avoid some of the negative consequences of having income be too high, meaning losing out on the senior deduction and certainly wanting to avoid the income-related monthly adjustment amount of the surcharge for Medicare Part B and Part D. And then in the future, each year thereafter, we're going to be doing their required minimum distribution. You got to do that first. And then above and beyond that, we're going to do Roth conversions again to fill up the 22% tax bracket and likely either get into the first IRMA bracket for a year or two or for a couple if we can justify it from the math and if that math all works out, or get them right up to that limit and each year do a combination of required minimum distribution first, withholding a bunch of taxes on that, and then some Roth conversion on top of that. Why is that important? Because you're going to be in the 22% tax bracket. So let's just pay the tax at the 22% rate, but then shift dollars into an account, into a into another investment that won't have a required minimum distribution in the future. Therefore, it's going to reduce our future RMD and will grow tax-free forever. That way, if and when one of them passes away and they're at single rates, that will help neutralize their required minimum distribution moving forward. It's going to take a while. So for those of you in the late stages of your career, early in retirement, begin doing this RMD planning with your CFP today, looking at all 6 areas of your financial life. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.